Distributed ledger technology introduces distributed ledger technology, DLT, commonly known as blockchain technology, as the foundation of digital assets within the program. Digital assets are electronically created, stored, and transferred assets that rely on decentralized record-keeping systems rather than centralized authorities. DLT enables participants within a network to maintain synchronized transaction records across multiple computers simultaneously. This technology enhances transparency, security, and data integrity because all participants share identical transaction histories. Cryptocurrencies such as Bitcoin operate on independent blockchains, while many digital tokens are built on existing blockchain platforms. Distributed ledger technology has emerged as a transformative innovation with potential applications across finance, payments, securities trading, and asset ownership systems. A distributed ledger differs fundamentally from traditional centralized databases. In centralized systems, a single institution such as a bank or clearinghouse controls transaction records and validates transfers. Under DLT, however, transaction data are distributed among network participants, reducing reliance on intermediaries. Transactions are grouped into blocks and linked chronologically through cryptographic techniques, creating an immutable chain of records. Once validated and added to the blockchain, altering previous records becomes extremely difficult. This structure increases trust within decentralized systems because participants can independently verify transaction accuracy. By removing centralized control, DLT may improve efficiency, reduce settlement times, lower transaction costs, and minimize operational risks associated with traditional financial infrastructure. Consensus mechanisms are critical components of distributed ledger systems because they determine how network participants validate transactions and maintain ledger accuracy. In proof-of-work systems, participants known as miners solve complex computational problems to validate transactions and add blocks to the blockchain. This process requires substantial computing power and energy consumption, but helps secure the network against fraudulent activity. Alternative mechanisms such as proof-of-stake rely on participants staking digital assets to validate transactions rather than performing intensive computations. Consensus protocols are essential because decentralized networks lack central authorities to confirm transactions. The effectiveness, scalability, energy efficiency, and security of distributed ledger systems depend heavily on the design and reliability of their consensus mechanisms. The topic also explains how digital assets utilize distributed ledger technology. Cryptocurrencies function as decentralized digital currencies used for payments, value transfer, or speculative investment. Crypto tokens represent digital claims or rights built on existing blockchain networks and may provide access to services, governance participation, or ownership interests. Distributed ledger technology also enables smart contracts, which are self-executing agreements programmed to perform automatically when predetermined conditions are met. Smart contracts can facilitate lending, trading, insurance, and other financial activities without traditional intermediaries. These innovations may improve operational efficiency and reduce counterparty risk, although they also introduce technological, legal, and regulatory uncertainties that investors and financial institutions must carefully evaluate. Despite its advantages, distributed ledger technology involves several important risks and limitations. Security breaches, hacking incidents, coding errors, and operational failures may result in significant financial losses. Scalability challenges can limit transaction processing speed and network efficiency during periods of heavy activity. Regulatory uncertainty also presents a major concern because governments worldwide continue developing legal frameworks governing digital assets and blockchain applications. Furthermore, decentralized systems may face governance issues regarding protocol upgrades, dispute resolution, and network control. Cryptocurrency markets are particularly volatile and susceptible to speculation, fraud, and liquidity disruptions. Investors must therefore understand both the technological foundations and associated risks before allocating capital to blockchain-based investment opportunities. Overall, topic demonstrates that distributed ledger technology represents a major innovation within modern financial systems and alternative investments. By enabling decentralized, transparent, and secure transaction recording, blockchain technology has the potential to transform payments, asset ownership, security settlement, and financial contracting. Digital assets, cryptocurrencies, and smart contracts illustrate the broad range of applications emerging from DLT development. However, these innovations also involve substantial technological, operational, regulatory, and market risks that continue evolving alongside the industry. For CFA candidates, understanding distributed ledger technology is increasingly important because digital assets and blockchain-based financial systems are becoming more influential within institutional investing, financial services, and global capital markets.